First and foremost, my name is Richard, and I'm a broker here with SoCal Warehouse. And the purpose of this webinar, this training here, is to unlock a lot of opportunities for anyone who either owns investment real estate or is in the process of thinking of investment real estate as an asset for themselves. And I think a lot of people, they're aware of the benefits of owning investment real estate. Some that come to mind top of head are like cash flow, appreciation, these things that maybe you've heard growing up, or even like debt, right? The power of debt and leverage, the fact that it's a hedge against inflation, amazing benefits. But we come around to this last benefit, in my opinion, that is like the cherry on top, and it's the tax benefits of owning investment real estate. And I think a lot of people are aware that there are tax benefits of owning investment real estate, but they just are not completely aware of what they are and how to exercise them. And I've had many clients that are just, they're sitting on amazing real estate and they just never squeeze the benefit of the tax benefits out of that property. So that's the sole purpose of this webinar, is to help educate those who currently have investment real estate, are in the process of buying investment real estate, or just want to educate themselves, or so that they can help their clients. Like if you're a broker and you're watching this. With that being said, that's the gist of it. And maybe you've heard. I'll leave before I hand over the baton to Anya, who's going to be giving us the breakdown on the class today. A dollar saved is a dollar earned, guys. A dollar saved is a dollar earned, and that's such a true statement, because when you understand that the tax savings that you're getting from owning investment real estate is actually, you could push it right back into your returns, and it dramatically increases your return on your investment. So with that being said, I want to hand over the stage to Anya so that she could give us a breakdown of her company, and how anyone who owns investment real estate could benefit from the tax depreciation aspect of it.
Thanks, Richard. Yeah, just share. Do you mind if let me see.
Let me make you the host right now.
Yeah, be the host. Okay, perfect. I'm going to share this. Slideshow. Okay. Thanks for having me. So I'm Anya Smelik. As Richard said, I'm with RE Cosseg, and this is just a Cosseg 101. I'm going to skip some slides. I'm not going to go through a ton. I'm not going to talk a lot. I really want to open it up to questions and answers at the end, but I'm going to give you a broad look of what cost segregation is, how it can help you with your taxes, and just if it's a good fit for you, or in the future if you decide to have investment properties. So our whole spiel, our whole thing is that we're just trying to capitalize the investors. There's the maximum of depreciation benefits, where we've got technology, virtual site visits. Everything that we do is to get you a good study with our lead engineers, but for a low cost, because cost segregation studies in the past have been really expensive. CPAs used to charge per the hour for them. And now we are able to do things with proprietary technology that can make it better, cheaper, and faster. And the product is still great and the same. We started in 2022. We've done over 5,000 studies, and we've saved our clients over $500 million in taxes. And overviews.
That's a lot of money.
It's a lot of money.
It's a lot of money.
A ton of
money. $500 million.
Yeah. And then, yeah. And you'll be surprised on the savings that you get if you, if you decide to do a study. So basically, let's start with just regular investment properties. Most properties, they depreciate at a 39-year life. So if you purchase a property, a commercial property, you take the purchase price, you take land out, because land cannot depreciate through the IRS eyes, and you divide it by 39 years and you get a deduction for that. So that's a regular straight line. If you have multifamily, or if you have like a single family home, or like a long-term rental, that actually is at 27.5 years, but let's just say for 39 years for a commercial aspect of it. Usually when you do a cost seg study, you could actually take out of the basis 20 to 50% of that value in year one. So once you remove that land value out of it, you could take up to 50% of that in year one of deduction through a cost segregation study. And we'll talk a little bit more in detail of how you do that, but that's just
And I
an
just want to jump
overview.
in because I've
Mhm.
immersed myself with this subject as an investor myself. So what you just shared with regards to the 39 years is like the you could call it like the basics, right? Like like an average Joe that doesn't,
Straight line.
yeah, just
Yep,
straight line. Like their tax preparer is going to ask them, if they own the investment real estate, and they're going to take their basis based on the improvement value and just straight line that 39 over the 39 years
correct.
on commercial. If it's residential, like you said, 27 and a half. So,
Yeah.
those who are watching this and those who have had the benefit of depreciation, but not cost segregation depreciation, they probably utilize this and maybe are aware, maybe are not aware. But what you're going to share today is just how to really do what they're doing on steroids, essentially.
Right. And so that's 39 years, you do get a deduction and you get a little bit of a tax benefit. And that's again, if you just purchased an office, handed that over to your accountant, the accountant will straight line that in 39 years, divide it, and you get a tiny small tax savings off of it. That's normal. That's how you should do it. But then jump in, and now we're doing cost segregation. And so like cost segregation study, what we actually do is there's things that don't depreciate at 39 years. They actually depreciate at 5, 7, or 15 years. And the IRS has said you can go in, you can identify those things. Those things are flooring, countertop, or landscaping, driveways, um, furnitures, fixtures. There's a slew of things that don't depreciate at 39 years. The IRS is like, hey, you can go in, you can find those assets, and you can assign a value to them. And then you're able to put them in the correct bucket of 5, 7, or 15 years. And that accelerates your depreciation and it front loads your tax savings. And you're basically, with a cost seg study, taking out an interest-free loan from the government. It's taxes that you should have paid that you don't have to pay. I'll move on, but I want to now get even in the nitty gritty of it. Now there's something called bonus depreciation. So we talked about some savings, right? Well, in 2017, a new law was passed where the IRS said, "Hey, you can actually take 100% of your savings year one." So if you purchase a property between 2017 to 2022, when you do your cost seg study, all of those savings that you get can now be claimed in year one. So all that income offset, all that depreciation, year one. It's starting to phase out. So in 2023, if you purchase a property, you get 80% of your savings in year one, and then the rest of the 20% trickle through year 2, 3, and 4. And then it's like a 60% in 24, 40%, and then it phases out in 2027. The new administration, there's going to be changes of it. I don't want to, get too complicated, but the good rumor is it's all going to go back to 100%. We don't know if it's going to retroactively go back to 100% or if it's going to start again in 2025 with 100%. But there will be bonus appreciation again with the new presidential administration.
And I just want to chime in and make a note on that. If we got any believers on the call or watching this, that's a good prayer topic, guys. Pray that we get 100% bonus depreciation back because that is it's astronomical. I mean, 100% to 20%, 60%. I mean, 100% is obviously where we want to be if you're investing or if you have clients investing, so that it's just one more reason why purchasing the asset it just makes complete sense.
Yeah, being a real estate owner is the best tax hack. That's how our government has set it up. And so real estate, people who own real estate, they have the best incentives because they want you to continue to own real estate. They want you to stimulate the economy with your purchases. So, like I said, the government actually does really like real estate owners. So now there's a process. Say you still not very familiar with this cost segregation thing, but want to see, hey, maybe one of my properties might benefit me. So on our end, we provide all our proposals for free. We can edit them. We can do 10 of your properties. We could do one, whatever you'd like. All you have to do is send us over a little bit of information. Most of that information is how much you purchased for the property, when you purchased it, and then the address of it. And we'll go on our end and we will research the property. We'll take all the land that needs to get taken out, and then we'll show you a conservative and an optimistic estimate. We'll show you what we think we can get you in depreciation, your tax benefit. We'll show you the fee. We'll show you the ROI and the turnaround time. And you'll get that in a clean document where you can look that over. And most of our clients or leads at that point take it over to their accountant. If their accountant's like, yes, this looks great, let's move forward. You e-sign, you leave a deposit, and then our engineering team onboards you and asks you to basically, most of it's uploading a closing statement. Sometimes we need the breakdown of renovation costs if there was any renovations. And then you get to schedule a virtual site visit. And that virtual site visit is what we're doing here. It's on Google Meet, but it's the same thing, except I'm a engineer, and on the other line just needs to be someone at the property that walks that property. We'll walk it together. They'll walk it together, take video pictures. And then within 30 days of that virtual site visit, you'll get a PDF with the methodology and then a fixed asset schedule. You hand those over to your accountant, and your accountant plugs in the numbers to your depreciation schedule. And then there you go. There's your tax benefit for 2024 or whatever tax year you're filing. This is kind of breaking down a rapid and fully engineered. I don't know if we want to get too much into it, but anyone that has single family homes are able to do a more of a questionnaire, and it's called a rapid study. It's much less expensive. And then if you have a fully engineered study, is more geared toward commercial properties, and both the fees are different, but we tell you the fee when we send over a proposal. And then every property, we've done everything from a single family home to a car wash to a ranch, a dental office, anything that you can imagine. We've done a study for almost every single property and in all 50 states of the United States. Basically, why should you get a cost seg? A lot of it is if you own investment properties and you have taxable passive or active income that you'd like to offset. We can move on if there's a question for it in the future, but basically, if you're a real estate professional, which means most of your time is in real estate and you don't get a W-2 from a different type of job, the cost segregation study can offset your active and your passive income. If you're not a real estate professional, it offsets your passive income, which is just income properties or investment properties that you have. That's what we just talked about. The definition of a real estate professional. These are questions more that you can talk to your accountant, but basically 50% of your personal services need to be materially participated as a real estate, like in real estate. The 750-hour test, again, you need to have at least 750 hours a year of doing real estate any kind. That means either property management or just purchasing real estate or buying something for your property. So anything that proves that you've worked on real estate. And then you must own at least 5% of the business, which is if you're like a broker or something, not 5% of the actual business that you're that you have real estate. Because I know sometimes people like own the single family home that's being rented, but they obviously don't, they're not investors in the property management company. So, and that's it, actually. That's all I have because of that, I have a case study, and then, those things aren't, we kind of talked about money already of what you can save.
Can you just do a brief case study, like just so that they see like
Sure.
the amount of money that you save? Like
Sure.
it's nothing small.
Let's do an office building. Okay. The office building will make a little bit more sense. Not everything has to be this high in purchase price. I just want to say. So basically, we have a client, they acquired an office building in Tennessee for about $3.5 million, and they wanted to do a cost seg study on it. And they wanted to see. So the purchase price was $3.5 million. The land value was $948,000, and we pulled that out. So the basis is 3.5 minus 948, so almost $1 million. What we did is it was a new construction, so we valued about 17% of it in the 5-year, 9% of it in the 15-year, and then the rest of the 73% fell in the 39-year life. And that's a total of that 3.5 million. And with a study in year 1, we were able to increase the depreciation by $442,106. If you just did a standard 39-year life, that first year, you would have been able to deduct $30,000. But with a cost egg, you'd get to deduct 442. So on that top line, your estimated first year tax savings, we're assuming they're in the 37% tax bracket, they would save $163,579 in taxes year one with this building. And this isn't like a unicorn or like something illegal or unethical. This is through the IRS that you are able to save that much money with the purchase of this building.
Right. And I just want to chime in there because, like you said, it's not a unicorn. This is something
Yeah.
that people have been doing for a long time. And unless you know this information, you will never be able to take advantage of it. And like you said, the government incentivizes you to own real estate because they're in the business of politics. They're not in the business of real estate. They don't want to manage property. So they incentivize property owners, investment property owners like ourselves or your clients to go buy real estate and deal with the tenant and get the property up to par so that it serves the local community. And you just shared how, straight line would have been $30,000 depreciation versus the bonus at, cost segregation bonus at 400 and in excess of 450,000, give or take, which is just remarkable because, like I mentioned, that's if someone was, making, let's call it $400,000 in their active income, right, through their earned income, they could offset that entire, that entire income that they made that year and pay literally no taxes if they qualify as a real estate professional.
And the good news, if you don't have that much to offset, say it actually rolls over indefinitely. So you don't lose your savings. You just roll it over to the next year until you run out of what the cost that gave you.
Can you go back to that slide with because this is what I really want to, so all right, $163,000, right? That would be the savings, right? You get to
the dollar for dollar tax.
Dollar for dollar, 160,000 is what you keep in your pocket and not hand it over to Uncle Sam willingly, right? So 163,000. So let's say theoretically somebody purchases for 3.5, and let's say that their cash flow was zero, right? So their cash on cash, if they're looking at it from that perspective, it's a 0% cash on cash, right? Well, that would entice them to maybe go put their money elsewhere. But when you look at it from this perspective, you're actually making, right? Because you're saving 163,000, and going back to my point, a dollar saved is a dollar earned. You're actually making 163,000 by owning that asset. So that should be accounted for in your calculations on your return on your investment. And for anyone that's looking to invest and you're watching this right now, or you're a broker and you're trying to just gather your head around this miracle is what I call it, this miracle of owning real estate. Like, these things need to be accounted for when you're looking at a transaction, when you're looking at a deal, or when a deal is being pitched to you, or you're pitching a deal to somebody else. And I just want to make that very clear because this is accessible to anyone that's buying real estate.
Good question.
And does someone have a question?
I had a quick question. Yeah. So the 30,000 down at the bottom would be a standard deduction if you just went to a tax guy and they just straight lined it. That would be what they would probably work with you. Oh,
correct.
Wow.
Well, yeah, because
that's
it's
like 15 times more.
Correct. It's the purchase price less land divided by 39 years.
Wow.
So that's the 30,027, which is a normal, that's most accountants do it that way. They take it in a straight line. So every single investment, everything besides your primary residence would be straight line through your tax return. But
now
correct.
when you take this to your tax guy, your breakdown, your statement and the breakdown, have you ever had a tax person, hey, we can't do this or we can't do that, like counter?
No, usually not. I would say the only time it's gotten where we have to use their numbers is, well, first off, that they don't have enough to offset. So say they have like a year where they're like, hey, we're at a loss, so we'll just wait to do this next year, the year after. So that's one. Yeah. Or if they have already, so say this property has already been a part of a tax return. Okay, so say this property was purchased actually in 2023 and they want to do a study for the 2024 tax year. but they've already filed for taxes. We have to go and look at the depreciation schedule and use that number. So that's the only time we've ever had any like back and forth of like, hey, your proposal estimate was a little bit wrong. Can you use the depreciation that we already have because if you just, this is maybe another question, but if you decide, you can do a study as far back as there's bases left. So if you purchase a property 5 years ago and it's only been, depreciating for 5 years, we can start from now moving forward with what's left over and accelerate that number.
But it's best to do it like right up front from the jump. That
It
way,
is best because the IRS, they're going to ask you to, oh, you got to file a change of accounting form now that because you were straight lining this and now you've got to accelerate it. Well, that's extra money, so that's why it's best to do it from the get-go. But we do, they're called look back studies. We do look back studies. I mean, 50% of our studies are look back studies because people have decided, hey, I've been sitting on this property and I've got a huge, tax burden this year. How do I offset it? And they do a cost seg. Thanks, Henry. Yeah, so let me get back on it and click. Okay. So yeah, that's it. My last slide is just, hey, if you want to get a proposal, please don't hesitate, reach out, and you can use the promo code bonus10 because you were part of this webinar to get 10% off of your first study. That is all. That's all I got.
I have a couple questions.
Yeah.
Interrupt you guys. So my first question is, if I buy a piece of land, is there any possibility to cost segregate a piece of land?
Unfortunately, no. The IRS does not think land is depreciable in that sense, and you can't. But say you build something on that piece of land in a couple of years, then you can use that entire construction cost to do a cost seg, and you don't have to take land out, obviously, because it's just construction or renovation. But land only cannot. There's got to be some form of
building,
some type of building, something like that.
Something to depreciate.
Correct.
That makes sense. My question number 2 is, in terms of the bonus depreciation that was done in 2017 to 2022, what does that look like in a simple example? Say if you can depreciate, let's just say $100,000 from a building, 100% on year 1. Does that mean that all your depreciation is gone year 1?
Yes, for acceleration, not for accelerated, but not your 39 year. You still have your 39 year. So let's say we depreciated 30% of the basis and we get all that 100% in year 1. Well, 70% of your basis is still available. So then your straight line is now being used up. Yeah.
You had a good slide for that, actually. If you want to go back, there's right there. You see the pie graph? Right there.
Oh, yes.
So the 5-year, the 15-year, and the 39 years was left over. So even if you bonus, like this one, they bonused the 442 so it was essentially the 5-year, right? The 5-year value was
I think they did. So it's a little bit off because the net depreciation is actually the difference, but it's actually 447 plus 235, the 5 and the 15 year.
And depending if it was like 180,
correct,
depending on the year, right? And that's what I'm saying. Pray to God that we get 100% again, because it makes an astronomical difference. Astronomical. Yeah. And this is back to, so now I want to go to like how an investor should be looking at real estate. That's why it makes sense to hold a property no more than 5 years.
Yeah, 3 to 5 years is what we say.
Like that's what, like, once you hold the property over 5 years, it's like one of your biggest dollar for dollar aspects of yielding money, which in my perspective is by utilizing this type of study, right? Depreciation. Once you're past 5 years, like that depreciation is like dwindling. It's on a straight line pretty much, just call it over the 39, and it's very minimal now. So that's why it makes sense to do a 1031 exchange into another property and do that cost seg again with that new basis. So it's just, milking it. You're just really milking it at that point.
Yeah, it's a running joke in the real estate world where you just basically purchase properties, cost seg it, sell it, 1031, cost seg, and then you do that until you die. And then you hand your portfolio over to your children or whoever, and then they step up in basis and they don't pay taxes on it either. So it's just, keep going.
Not
I'm gonna use that, bro. I'm gonna use that.
Yeah, not a bad life.
Not a bad life.
life.
Use that.
Any other, does anyone have any other questions?
That was a great question, Angel, with regards
Yeah.
to land. So yeah, it needs to be improvement. So when you get a tax, like from the tax assessors, when somebody buys a property, there's land and improvement value. Any of the
Right.
land value you cannot depreciate, and that's one thing that needs to be stated here. Yeah, that it's the improvement value is essentially the actual building component of the property. So there's people watching this, including myself, that invest heavily in land. That's one of the benefits that you don't get in investing in land is that you don't get that tax benefit. That's been the case for me, and that's why it's important to diversify your portfolio so that you have properties that you can depreciate to offset any of the passive income that you're earning from the land investment. Let's call it. Any other questions? I had a question for you, and you answered it already, but I think it's important to know. If you could still do a cost segregation analysis study, even if you've already started depreciating the property over through the straight line process, you could still go back and still utilize this service, right? Still utilize this, even if you've already commenced doing it the more traditional route. And that's important to know, because I feel like people that are going to be watching this they're sitting on a property that maybe they've owned for quite some time already, and they're going to have FOMO, right? But no, it's never too late. It's never too late.
Yeah, and we don't even have to go to the 3.5 million. Like, say you purchased just a duplex for not just a duplex, but a duplex for $250,000 4 years ago, 5 years ago, or whatever. That has now been depreciating at 27 and a half years for a couple of years. It's not that much that's been pulled out of that. So we either can run the numbers just assuming depreciation, or we can get the depreciation schedule from the accountant. We can get that basis. We can run the number. And the biggest thing is just getting you those numbers in front of your face to see, is this a good ROI? Is this worth it? Most of our fees, they're worth it. You'll be like, okay, hey, this fee is way low. That's worth spending just to save, even to save $30,000, but spend $1,800 on a study. That's still worth it, I would believe, in tax savings incentive. So what I just encourage everyone is just ask. Just say, hey, I have this property. Can you run the numbers? Everything is free of charge. None of that, you don't have to pay for any of that. So it will not hurt to ask. It wouldn't hurt to run the numbers on everything that you own, or if it's just one thing, and you can look through it and say, okay, this is worth it. This isn't. Or even my next property, I have clients who are thinking of purchasing a property, and they ask me to run the numbers. Hey, run the numbers on the property I think of buying. I'll do it. And he's like, oh no, that's not going to give me a good enough benefit. I'll move on to the next property. So.
Yeah. And that's what I like about, I personally work with you guys now. So that's what I like about your guys' process, is that the numbers speak for themselves. And when you're looking at them, you can make an informed decision based on the savings, if it's going to be worth it. Because I ran a couple options with you, and not all of them made sense, right? Because some of them were land, and the ones that did make sense, they made complete sense. And just going through your process, you've been very helpful. Your team's helpful, and that's why we have you on today, because we want to share your services so that other people could benefit from it as well.
Thank you.
Yeah. Any other last comments or questions? Because we're going to go ahead and wrap up. Cool. Well, Anya, we appreciate you. Like I said, this is recorded, so we'll share this with everyone who attended and those who weren't able to make it. If you guys have any questions, you guys could reach out to us directly. You could Email us info@socalwarehouse.com. Again, that's info@socalwarehouse.com. And we look forward to helping you all get very wealthy. All right, guys.
Thanks,
You have a
Thank
good
you
one.
guys. I appreciate it.
You got it.